Morning. It's Deadsville in the markets today, so I thought maybe we could take a look at some stocks in these quiet hours. We're not looking at stocks now, obviously. This is a picture a friend of mine sent me it's a train museum in Lancaster. I visited a great train museum in Sacramento, and this was quite a few years ago, and I remember the dining car had a setup similar to this. This is essentially itemized for display. The dining car that I entered had the full treatment with linen tablecloths and in this case the same sort of spode china with the the railroad logo etched into the borders, and all the trimmings. And keep in mind, this would be, I'm guessing, somewhere in the 1940s that they set a table like this in a train. And this is not a first class dining car, it's just a dining car, so everybody got served this same way. And if you compare that to airline amenities today, or any kind of travel amenities other than private jet, you realize how far the standard of living has slipped. We've got a lot of electronic gadgets and gizmos to distract us from that fact, but this is the way economy class travelers ate on a train in the, again, guessing late 1940s, early 1950s perhaps. We see food here that would probably, tip included, have cost maybe $3.50. The fact that the same setup on a train, if it were possible, if any railroad even provided something remotely like this, it's certainly not Amtrak, this same spread would be maybe $60 or $70. Food always being a little bit more expensive on a train. All right, let's take a look at some charts. This is a Q&A session, so I'm hoping that you guys venture forth with questions concerning your favorite under-traded issues. I'm getting messaged to death here, so let me shut down my Outlook. And do I dare shut off my phone? Let's shut off this little thing here. And what else do I need to shut off? That's about it. Again, we've got, let's see, 24 people in the room at this moment. I am expecting more. I am planning to hold, I guess it can't really be called an impromptu session because it's going to be scheduled in advance, but I'm going to give advance notification of one of these open-ended Q&A sessions with enough lead time, maybe 4 or 5 days, that you guys can send the links as an invitation to people that you know out there in the trading world who might find these presentations interesting. So I'm surprised, 24 people, not a single question. My audio is working, so let me ask once again. All right, John says that Cree tripped, looked like a buying signal. Cree, of course, is an Indian tribe. Let's see what we have here. Well, it does have a nice little buyable pattern. The thing that you're going to like about this rally in Cree Inc. is that it did get past that external right there, and it makes it a pretty good impulse leg. Let's step back and take a closer look here, blow it up a little bit. I'm thinking this is slightly, it looks like a slightly one-off A down there. Let's just make sure. Yeah, this low is a nickel beneath that one. So this is a discrete standalone one-off A. And the pattern I would use to project, although not to trade, would be like this. Tripped an entry signal at 36.45. I think this breakout from the consolidation that's been happening since October is a little bit too noticeable. So I'd be very wary about getting in at 36.45. My gut feeling is that this thing is going to stop everyone out below 34.35 before it takes off in earnest. But as you know, it's always possible to test the water risking just nickels and dimes, and we do that using what I call the camouflage technique, which involves trading patterns that we find on the very lesser charts. These patterns have commensurately smaller stop losses. The stop loss, or the initial risk, is essentially the differential between the X entry price and the point C low of these ABCD patterns. I don't see anything on the 3-minute chart to get us in. The impulse leg that I would normally be looking at would be A, B, but that's only gotten past one internal, and there are no externals. So it's not very promising. But we could break the rule here and just get on board anyway. You'll see that that the stock is definitely being watched by people who have been looking for some sign of strength, because on the opening we had a pretty good rally, so everybody's bullish up there. Everybody says, hey, we broke out above some of these peaks from Friday, so everybody wants to buy it, and you can see that the stock troubled itself to stop everyone out 2 times before it took off for, in this case, nowhere. So to me, it looks like it's very much overwatched in terms of number of traders out there with their fingers crossed, hoping this is it, that the stock is finally breaking out. So I'm not too enthused about jumping on it here, but if we were going to do it, risking, again, pennies, we would take a pattern as small as, let's say, this one, A, B, C, enter there at X, and of course you can see go nowhere. It's not a total, I don't know what the word is. It's not a total waste, because, if we're entering an A, B, C, D rally pattern there, we do have another bullish pattern driving it, that A, B, C, D, that has its own target. So you've got a little bit of 2 patterns pushing it if you make entry on these very lesser charts here, and you can see the risk is of a very small order. Let me tell you what the exact entry risk is theoretically. If we're in at 35.99 and we stop ourselves out at 35.93, we're risking a theoretical 6 cents per round lot. So that's not bad. It's much better than the almost $2 risk, dollar something or other risk of that big pattern that I just showed you. So, all right, let's take a look at next request, US dollar, from our own Dave Williams down in Haiti. The dollar, I was talking with my trading partner this morning, John, and he disagrees with me about the dollar. My gut feeling is that it's going to go up forever, that there is no target. I think the dollar, it's not in a short squeeze, because the dollar rally, as steep as it's been, is not quite, it's not as out of control nutso as a short squeeze. And of course, good thing too, because when the dollar is in a true short squeeze, when essentially, for one, all borrowers of dollars in debt that rolls over every 18 hours, very short-term debt, they're not going to be able to roll over. Their lenders are going to insist that they settle in cash, and that's going to put a squeeze on the dollar. But right now, we just have a rally, of a squeeze of a different sort. I use the term squeeze because the dollar is going up, and everybody's starting to get nervous about it, most particularly the Fed, even though acknowledging that is never going to be part of their management of our expectations. But everybody's a little nervous about it, because even though before the dollar started really getting strong, nobody, I'm talking about looking at the whole world, the population of however many billions of people there are, nobody really thought about what would happen if the dollar got really strong. But what we're seeing, today's Wall Street Journal story, is that the stronger dollar is going to force some multinational U.S. banks to have to put more in reserve. But we've seen some of the other results with Q4 earnings. All the American multinationals took a huge hit on foreign earnings, and of course that it may not have made a crucial difference with Apple. Apple made so much money that even with the currency hit, they were still able to report a great quarter. Caterpillar, not so much. You know, Caterpillar has exposure globally to what we would call real economy events. It's not the financial BS. It's Caterpillar operates in the real world of heavy machinery, and the currency hit against Caterpillar was one that brought intimations of despair from their top brass. You know, Caterpillar's basically saying, we don't know how we're going to survive if the dollar, well, they'll survive, but we don't know how we're going to prosper if the dollar continues to get strong. So when I describe the dollar strength as a squeeze, it's not so much that the real squeeze has begun, but more a matter of the dollar's going up and people are shaking their heads and thinking there's nothing we can do about this. And that's the simple truth of it. You know, if you've got money that you want to park somewhere, you certainly don't want to park it in Europe or China for that matter. Nobody really parks money in China except the Chinese. But so the dollar is strengthening, and it's starting to create a little bit of nervousness, and just the fact of nervousness and danger is not exactly that's not going to bring the dollar down. So the dollar is in a prelude to going bullishly out of control, and I don't think we have to go any further. We'll take a look at the longer term chart here, but just to get the lay of the land for now, let's see if I can get TradeStation to behave. You can see it's just sort of stumbling around at a midpoint resistance, and once it pops through, we're going to see a rally to 96.27, which in percentage terms is a pretty good gain for this little pup. Let's take a look at the daily chart. You can see an uncorrected impulse leg here. Well, it's corrected on the daily, but let's see if we go to the monthly, really long term. The monthly is where the dollar really makes a statement. Let me show you, get rid of some of TradeStation's garbage here. All right, you can see that since this last vertical phase of the rally, which began last May, so we're pretty well into it, there's no corrections the entire rally. I mean, we've gone since last May with no BC pullbacks, and as that has happened, we've seen the dollar get past a little internal there, another slightly larger internal, a major internal there, an internal there that's so major that we'll call it an externalish internal, and now most recently in January it got past a genuine external. So it's gotten past a zillion prior peaks and still no correction, and that's what's telling us that this is the real deal. This is not just some flash in the pan rally. You know, we should be thinking in terms of a test here of this long-term top back in 2001, 2002, up near 120. So we're at 94.58 right now. Imagine what kind of strength that is, and also factor that into your assumptions about gold, because a strong dollar is not exactly going to be good news for gold. Although I would have to concede, up till now, the dollar or gold has done pretty well holding its own against a very, very strong dollar. Not only that, but gold has held its own against the thing that it hates even more than a strong dollar, and that's a strong stock market. So all things considered, I think you have to like the action in gold here, even though it's been a little bit It's been in a bit of a wallow. It can't rally quite as far as we should expect it to rally. The rallies are falling short. The last one should have reached 1330, and it only got to 1308. So and last few days, gold has really gotten hit. So the rallies are disappointing, and the sell-offs are really pain. But when we put that in the context of the gold not really getting shellacked in an environment where the dollar and stocks are rallying, you have to. I think that's probably the single strongest reason for optimism concerning gold. That said, I am a deflationist, and I'm always going to be a little bit skeptical about each rally signifying a move to, $2,000 an ounce. I'm just not in that camp. All right. Any comments on March Treasury bond futures? Let's take a look here. I am recording this session, by the way, and you know what? I always forget what it is that we covered during these sessions when I put out a note on what we covered. So let me see if I can. All right, so we looked at Cree and USH DXY. We're looking at March T-bonds, and you can see that we had some potential for some real trouble this morning. It needed to go just a little bit lower to take out a second external low. We didn't quite see that. Whatever was going to happen, I was pretty aggressive in my advice. The headline commentary for this week is that you basically have to bet against anyone who's selling T-bonds or predicting an end to the bull market. We are a long, long way from the top. Yeah, I have to admit that all the price action so far in 2015 looks like maybe an incipient head and shoulders, and I'd be pretty careful if this thing rallied back up to what's looking like a right shoulder. I don't put much store in head and shoulders formations, mainly because they are everywhere that you want to see them, and also because when you ignore the technical refinements of a true head and shoulders pattern as set forth by Edwards and McGee in their classic work on technical analysis, you wind up with a lot of head and shoulders patterns that really aren't head and shoulders formations. One of the qualifiers of these patterns is volume, which is something I don't even track. But most of the head and shoulders that get mentioned are only on a basis of appearance and don't take into account the volume component that is intrinsic to the pattern and the way it works. All right, so this is a pretty top-heavy. It looks distributive to me, and I'm going to be kind of careful. If we distributed and came down even harder, I wouldn't be exactly giving up on bonds. I do think the long-term yield's going to come down to 1.74%. I just think there's a lot further to go, just as I do with the dollar. It's basically that it's being fed by it's not panic yet, but it's really it's being fed by an incipient unwind out of all the bad crap like stocks into the only place, the last man standing, presumably the dollar and dollar assets. So so I'm forever bullish on T-bonds, but yes, we could still get a rally and then a nasty swoon that would, it's not going to do much damage to us. We've been playing TLT with pretty good timing here. Let me get this thing out here for you. I've been in love with TLT, and we've done all bullish positions until here. I had put out a 138.42 target, and we came within pennies of getting short at the top by legging into a put spread. When it was trading up here, we bought the 132.5 puts expiring February 20th for 40 cents. As it came down, we were able to sell puts $2.50 lower on the strike for 6 cents less than what we paid for those puts up there. Yes, we actually could have put the spread on for a credit, but I always like to take profits when they're there. So we locked it in. We also bought a little bit of stock at I think it was 133, and the position has worked out nicely. We're down. We essentially did enough stock to offset the 20 negative deltas of each one of the spreads. We bought the spread 10 times, which at a particular price made us short the equivalent of 200 shares. But as it came down, we picked up a few deltas on the put spread. And when we own stocks, the value of stock obviously is going to be $100 no matter where it's trading. So as this thing was coming down, we were getting slightly shorter. And as it goes up, we get slightly less short, which is to say slightly longer. So it's a back spread, and a price we pay for that kind of flexibility and to be in a situation where any move in either direction is going to make us money. The price we pay is the time premium for the put. So let's take a look. I think I'm getting confused here whether it was 132 or 133 where we all right, so where we bought, I think it was 133 where we bought the stock. Yeah, 200 shares at 133, and that was a midpoint pivot. You got to pay attention when I put these things out, because some people just bought willy-nilly down at 133. But my whole reason for buying there, it only worked if you were already long the put spread. If you're long the put spread, we'd made plenty of money thus far. So jumping in and buying a little stock at 133 was it was a no risk play. But if you were just newly staking out a position at that price, my advice was different. You could buy at 133, but you needed to keep a tight stop loss. It's only people with the put spread who can buy at 133 and say, go ahead, do your worst, drop 3 points. I don't care. I'm only going to make money. So you had to distinguish there between my position recommendation if you held the put spread, and I was pretty explicit about that in the tout, about buying the stock as a hedge against the put spread. All right, so I'm not sure the selling is over in this guy, but let's take a look and see where our all right, so we are in a Feb 20 put spread. It's got some time left on it. When the month begins on a Sunday, it's things don't expire until the 20th of the month. You have 3 full weeks. So we've still got 2 weeks, less half a day on the put spread. But all right, so this is the one we're in. We're long the 32.5s, currently trading, let's call it 210, and the ones we're short are trading around, let's call it 80. So the spread's worth $1.30. We paid 6 cents for it, so we're up 10 times. We're up $1,240 on those 10 put spreads, and we are, let's see, on the stock, which we bought 200 shares at 133. Let's see, so $1.13, 226. So we're up $1,000 on the position. Now, just to be clear, this was one of those spreads. I put out different types of trades over time. Some are going to be accessible only to people with a little more trading experience, but the TLT spread was especially geared toward people not only with relatively little trading experience, but people who have been dabbling in options for 5 or 10 or 15 or 20 years and never had a winning trade. I know a lot of those traders. All right, so this was one of those trades that I thought had a good chance. You know, if you've never made a dime trading options, do this. And it was pretty straightforward as far as, you know, buying the puts initially. And I simply took actual prices that were reported in the chat room by people who had done the trade, as is my practice. I never make P&L claims for things that I put out unless someone actually made money. And of course, that is the way that some of these option services hype their records. They talk about theoretical P&L, but we all know that just for someone to tell you to buy an option for $2.23 merely because it traded there or even a little bit lower will not necessarily mean that you've been able to buy it. So I don't buy anybody's P&L claims out there in the guru world, but for myself, I only use trades that are reported by subscribers. I never want to be one of those gurus who's in a position of making a great deal more money than my subscribers. Doesn't look good. Robert wants to take a look at GDXJ, which continues to test our patience. Let me see if I can wrestle TradeStation into some state of usability. What a garbage. Hang on, I've got to go to some other, well, I have to go off GDXJ and now return to it just to fool TradeStation into being other than recalcitrant. All right, so trying to think of where the big pattern was. Oh, here, you get beautiful clarity here on the 60-minute chart. Actually, less than perfection, though, because this winds up being a very sausagey point B. It is just a zillionth of a millimeter above that key low, and it distorts and it mars the usability and the perfection of the pattern simply because everybody knows why this bounced. We got all the village idiots in the world focused on buying here, counting on possible support from that structural low. So I like my hidden pivots to be away from these structural elements that attract the riffraff and ahoy polloi, but in this case we weren't so fortunate. But I'm going to pretend that I am a CETA worker trading equities for the U.S. government, so the pattern is plenty good for that purpose. And we see something of a midpoint effect here. You know, this thing has been down once, twice, thrice, 4 times, not quite getting to P. And all we know is that if it breaks P, it's going to D. And if it surpasses D, we're going to have to slide A up to here for a new target. Or and this is actually not a bad impulse leg, even though we've got this sausage effect with this low roughly tying that low, because what I'm calling an impulse leg, a straight line AB from there to there, it doesn't look like a straight line because of this bend in the road, but we like that. It throws all the Gartley guys and the 1, 2, 3 pattern players off the scent of some really savory patterns. So what I like about this is that the segment that I've selected as AB did get past one did get past 1, 2 prior lows, internal and external. So I like this pattern. I think it will work just fine. And rather than pretend we have a crystal ball, we'll just have to see what it does relative to 2614. It's going to either fail or it'll hold. It doesn't hold officially until we get an impulse leg going in the other way, which would happen at this point if we rallied up to here, getting past this internal and that external right there. So GDXJ is in limbo land. That's about all I can say. SPY, what is that? Do we even do that? I'll do the futures. I'm not quite sure what the point is of looking at S&P. Well, let's take a look. Maybe there is a point. What is this Michigas here? Looks like an uncorrected. What is that? I don't even know what that is. Was I asleep when this happened? Is this some sort of hysterical mirage? All right, I don't know about SPY. John says, I'm holding the stock. He's holding this, whatever this is, Linn Energy, with the cost basis of 1065. Based on your view, would it be smart to sell calls here or look for a higher high? I'll say what I've always said. I've said it 10,000 times. Take a profit. Just take a partial profit. You know, you'll worry less about it. You'll do the right thing. We have a request here for crude oil. And you can see I've targeted 58 on the basis of a midpoint pivot on a downtrending pattern, but let's see, it looks like we're on this daily chart. Well, the daily chart actually yields a precise target at 58.02, so that's where it's going. Alejandro wants to look at Priceline. Could we trade crude right now, long or short? You bet we could. It's always possible. Let's just to prove the point. Let's see what we can do. All right, well, we need something less than a 1 minute chart because we've got nothing here on the one. So let's take a look. We'll start with the 15-second, but we're going to work our way even lower. See if we can get a trade out of this right here. All right, so I'm going to drop down to the, again, we're looking for an actual trade here. I'm going to drop down to the 3-second bar chart and see what we can find. All right, you can see, well, actually, I'm not seeing multiple opportunities pop up here. The last really good one was here. It's a beauty. A, B, C. And the only reason it worked so well is because you didn't have much time to get on board here. That's why you've got this spiky stick. But in terms of what we look for, you know, to define impulse legs that are tradable, you couldn't do much better than A, B, C. So we had an entry there. Let's see what else we can do. All right, this one fits that description of do the trade even though the pattern isn't impulsive. We've got A, B, C, and this thing is moving so fast I can't get the coordinates correct here. All right, so here's the pattern, and I would have said short it at 53.01. Reason being, just to this isn't too terrible. This is slightly proprietary, but our old ABCD patterns where we look for AB to surpass at least one internal low and one external. In this case, especially in the case of the E-Mini S&Ps, I'm more and more liking patterns that go A and the B doesn't surpass the external, it's equal to, because the problem is, especially with the E-Mini S&Ps, the instant that this thing actually breaks down below that low, every algo trader, every mathematician who doesn't know the first thing about trading becomes mechanically bearish. So they all want to short it. So I like sort of disguised patterns, of which this is one that did not work. Well, it half worked. If we're short at 53.01, we're actually, believe it or not, covering half the position 2 ticks lower, so that we've lowered our break-even stop loss up to here. So I think we could have gotten out on a scratch on that trade. But again, I'm trying to force a trade here to show you that it's possible to trade long or short at any time. You just have to get on a time frame that suits your needs. All right, so in this case, we've got guaranteed 53.16. That's where it's going. If you did the mechanical trade here, we've got a whole 10 cents worth of profit potential. So we would have been using a 3-cent stop loss there mechanically. Well, let's call it, use a rounding factor, 4-cent stop loss on the pullback. So we'd be stopped out at 53.02. The actual low was only a penny beneath there, 53.05. So on a pullback to P, mechanical buy there, we're using a 53.02 stop. OCO, one order cancels the other with an order to sell however many contracts up there. Is 53.16 shortable? Yeah, I think so. We could probably do it. I would be a tick below there just so you're guaranteed to get filled. A stop loss no wider than 3 cents, 53.18. I'm sorry, 53.15 offer, 53.18 stop loss. The stop loss isn't going to hurt us too much on slippage, simply because this 53.16 D target is not a place where everybody even knew to get short. It's not like stops will get run above that line. We're the only people on earth who know about that line, other than some of those grizzled old veterans of soybeans and pork belly contracts and things of that sort. All right, so technically, and with any luck, we were short at 53.15. We used a 3-cent stop loss, 18. There's a stop right there. All right, so this is a sign of incipient strength. When you have a nice clear pattern like this one and the vehicle gets past it, it shouldn't have. So I take that as suggesting this thing is moving higher. Alejandro wants to look at Priceline. Actually, we don't need to. When it's one thing to trade crude on a 3-second bar chart, you're always going to be up against people who are smarter than you can believe, who are savvier traders. But in Priceline, it's only a bunch of idiots trading it. They blend in really with the institutional interest in the stock. So all you've got trading the thing is just mathematicians and other non-traders, and so the patterns tend to work better, for Priceline. Priceline is easier to trade than crude oil. The commodity complex tends to attract a better breed, a smarter trader. But as far as I'm concerned, Priceline, it's just a lot of machines trading it, and we can beat the crap out of the machines because again they're programmed by mathematicians, not traders. But the one place where we shouldn't be so presumptuous is liquidity. So we may have the best of intentions, buying 1302.90 or something above that, slightly above it, but we all know that it can hit our price and not do anything for 5 or 10 seconds and then trade all the way down there. So sometimes it's you're mistaken to think that you can trade this thing all the time with just 3 or 4 cents risk on 100 shares. It does some pretty crazy things, and that comes with the territory. So I'm not even sure whether we would have got this. You have to watch it for a while because we would be looking to buy 103.290, and we only got down to 103.3.06. 16 cents is it's not a lot. It's not a big miss for a stock that's trading over $1,000, to have missed nailing the low by just 16 cents. But by our lights, we really need it to come down to closer to the target to get long down there, because I don't think I could rationalize bidding 103.006 for a 32.90 target. All right, so anyway, you can see on this 3-second bar chart how Priceline it's easy to trade in the sense that we know almost exactly what it's going to do, but logistically it's difficult because, you don't always get filled the way you think you should have been filled. All right, looking at it, we've got a real nice, a very targetable pattern that is working right now, right here, and we're above the midpoint pivot, so your trading bias should definitely be bullish. And on Priceline, a little bit of distance is a lot of potential profit. We've got 20, 26 bucks differential. We get in long at the red line. We have 26 points of upside. We could have set an $8 and 66-cent stop loss, meaning we're in at 1033, stop loss at 1025, OCO with an order to sell half or 3/4 of the position at that D target 1059.55. If and when it gets to 1059.5 1059, you can see that will be newly refreshed impulsively. To reach that target is as much as saying that the rally will have gotten past internal peak there and a choice little external right there. So it would be a good sign for Priceline, which has been in a dirge since the second week of the year. Actually, no, since the third week of the year. Well, almost the third week. So that's what it's doing, and we've already seen the 3-second bar chart to discover ways that we can get in with relatively little risk. Patrick jumped in late. Have you looked at gold and or silver? We don't look at silver too much, but let's take a look today. If I can get TradeStation to... All right, so we want to discard that. It doesn't seem to be worth much, but one thing that is worth much is right here. Let's see, 3 very clear, sharp coordinates, and I would have given this thing up for dead here. I would have said, no way, this thing is not going to reach 16.315. The target will remain valid in any case, unless this thing rallies above our point C high there. But you can see, I think what you could say about silver at this point is that its failure to reach a really easy target at 16.315 is bullish. If a stock can't quite sell off to as far as it should, then by implication that is bullish. So, but in very short term, it's just a trade. You have to find something here to trade. We've got a nice rally. It looks kind of ABC-ish until we noticed that the rally didn't get past any external peaks. We need to go on a chart of lesser degree to make sense of this, and we do here. I need to, let's see, I need to create an external peak out of that thing right there. So the only way to do it is to get down. We'll go down to a chart of lesser degree, and now we have more stuff to play with. We had a good impulse leg. This is definitely a really tradable leg. A, B, and look what happened. The little sucker, instead of pulling back a little bit, another rally, it went into dueling mode. Bullish impulse leg followed by bearish impulse leg, and since then it's been somewhat. There's nothing to say about silver. You can still take. I think we can make a targetable pattern out of this right here. Well, it's always going to be targetable. The question is whether we can actually trade it. So this is what's happening in a somewhat bigger picture, and the pattern itself is confirmed. It's validated by the action centered for the last couple hours at the P midpoint. This thing is definitely, it knows that P is there and it's having its troubles. So all we can say about silver is that if it blows through it, it's going to go to 17.300, more or less exactly. And as far as getting long for that ride, which is not bad, we're talking about a ride of 29 cents there. That's worth quite a lot of money in silver. I would suggest you get down on the very lesser charts everybody's kind of in on a bullish thing right here, you know, with the rally that we've had today, pullback and an obvious or apparent resumption of the rally. Everybody's bullish here. So we need to use only the very subtlest entry signals that would come off charts of even less than 4-minute degree, although you should have a reason on this 4-minute chart to get long, which you do right here. A, B, C. We were tripped in at 17.024. So from that time forward, we were justified in looking for entry opportunities on charts of even lesser degree. Let's actually take a look at lesser. We'll go down to the 1, get rid of these lines, and we get some pretty subtle stuff here. Well, I'm having trouble. This is definitely impulsive, but we just haven't had a pullback to C yet. But this is the pattern that I'd be trading in silver. A, B, maybe C, and who knows. Be ready for a quickie there, you know, A, B, C, and no sooner as it makes some low down there than it starts running back and trips the X entry signal. Of course, those of you who have been through the hidden pivot course know C doesn't exist until we get that X entry signal. All right, this is where we should be ready for what most traders aren't ready for. So we're gonna well, maybe we could go down to the 30-second chart. I don't want to wait for a whole minute for this thing to adjust. So now I wonder if we could get down to the 15 without compromising the pattern itself. 30, 15 second. All right, so even on the 15, we've still got, now we only have to wait 15 cents for the bar. Another pattern I'm liking more and more is the BC pullback that comes almost down to A. This is sort of middle of the road, and it's going to leave rather more bulls in a picture than we want, than if it came all the way down here. But all right, so the question is, on a middling day where silver is not doing much, do we take the entry signal at 17.058? My answer would be no. I would take a second signal, a second X following a second P, but so far we don't even have that in prospect. So all right, what I'm saying is that if we get in at X, I think there's at best a 50-50 chance that the rally will get us to P. So on a day when we're really desperate to trade and bored out of our minds, we might do the trade, but today, you know, we really should practice being risk savvy, and in this case, you know, there's no urgency about jumping into a trade when we've seen silver just kind of take these mincing steps today. It's in a little bit of a wallow, bullish, but not really going places in a hurry. So, all right, I don't want to stick around on silver forever, and I'm trying to remember, did we give the big, all right, we gave a somewhat big picture there. Let's take a look in gold. Gold, you know, you can see it's behaving pretty well. 1229.80 was about as bad as I could have seen it, and you'll know we came in Friday with the 1240 target that came off this pattern right here, and I was away. I was skiing on Friday, and just hoping there was somebody in the chat room who saw the obvious here, and that is, if you've got a target this beautiful and the thing just smashes through it, you better start looking for another target lower. So the only place you can get lower is by sliding up to there, and it gave you the last target that you could project off the intraday charts at 1229.80. The actual low was 1228.20. So not exactly what I call, that's not what I call a dead center bullseye, but it's certainly in the ballpark for trading. And in retrospect, you can see that we did get a nice tradable low down there. Tradable certainly by the lights of most of the people we compete against. Less tradable on our terms, simply because we're looking for the very precise hit. In retrospect, I would say that the hidden pivot didn't work to within a dime as I might have expected, simply because this thing came down and the village idiots that we like to think we're trading against saw this structural edifice right here and thought, well, there's where the support comes in. So support somewhere in here kind of vagued out the hidden pivot effect. Although probably as often as not, or maybe more often than not, when something's coming down, 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 and we know all the village idiots are going to be buying somewhere down there ahead of anticipating support from this structure, we have an exact number to work with. And I would say at least half the time, maybe most of the time, when this thing comes down and it turns where everybody expects it to, the actual turn comes from where we expect it to and not from, oh, somewhere above this cluster of lows. Speaking of structure, I saw a movie trailer for the first time on over the weekend. It was for a film based on the amazing feat of the century by Philip Petit, the guy who strung a high wire between the trade towers and walked that wire. It was it's quite a story as to how they set up bulkheads to anchor the high wire on each building. It was really a lot of cloak and dagger stuff, but the trailer itself, without telling too much of the logistic story, it gives you a sense of Philippe Petit himself, Philippe Petit. They put him out on a girder, a beam that's kind of sticking out from the roof of one of the trade towers, and in the short space of this trailer, he breaks the cardinal rule of acrophobics and looks down. And it's only at that moment that you sense that this guy is absolutely he's so self-possessed, so self-confident. His mastery of a physical skill is such that he can look down fearlessly. I guess you have to be fearless to start with to walk out on that girder. Anyway, from the visual standpoint and the inspirational, the trailer for that movie, it may be the best I've ever seen. I'm a movie buff, but it's a real grabber when he walks out on that girder. Definitely a must-see movie. Kyle wants to look at everything in the world. Oh no, just silver and copper. All right, so you. Let's take a look at copper. HGH, the March contract. I'm looking for at least, I think it was 2.66 up there, but I have to say that I'm a little disappointed with the way this sack of cement is deliberating. It's not like the target. Yeah, 26675 is my target, and it's fine. The target is theoretically valid unless this point C low gets taken out, but copper doesn't seem to be in any great hurry. Because of the nifty rally we've had in oil today, we might have expected a little more from copper, but it's just kind of a stick in the mud today. Let's take a look at a somewhat bigger picture. Same as crude, just a bear market with a bounce from a little below a place where we might have expected it, but I see it as a dead cat bounce in a deflationary world. John got in late. If you haven't looked at the dollar, we did look at the dollar, but you can review the recording if you'd like, John. Isn't that move on February 7th in silver a renewed bearish impulse leg? Let's take a look at that. The move on. All right, so trade station. Let me see if I can get rid of all this garbage here. All right, so Patrick says, isn't that move on February 7th in silver? Is that wait, today is the 9th. So, no, I mean, I don't see anything going. I mean, I just see what I see here. But, let's see. I mean, I don't see anything happening in silver of real interest here. All right, well, I have recorded this, and let me, before I GCJ, I want to record that from the questions panel here, the stuff that you asked about, just so that I know. Copper. All right, what else did we look at? L-I-N-E, Linn, whatever it was. Priceline, crude. And if you guys, I mean, I'm still here. We haven't even gone an hour, I don't think, today. Or actually, we're just coming up on an hour. Time flies, doesn't it? All right, so we looked at Priceline, SPY, GDXJ, ESH, and I think that's about it. All right, let's see. So, all right, so if that's it, if there are no more questions, let me first put in a plug for the webinar. It's coming up on Tuesday, February 17th, 3.5 hours, and we still have a few seats left. Ron wants to look at beans. I'm not sure which contract interests you. Oh, actually, this is sugar. It's let's see, SH15. So this is the March contract, and you can see a pretty clear bullish rally pattern. I'm going to use this low right here. It's sort of the point of departure, the takeoff point for this thing, and you can see that Friday we had some very precise resistance at the P midpoint. So again, because we never pretend that we have a crystal ball, we don't presume to know what it's going to do. Just to sort of clear the slate, you should be thinking, well, it's possible that this last little push up here will be the highest high we see in soybeans for the next 20 years, or by the end of the day we could be blowing through it. What we do know, based on a very precise action at P, is that if and when this thing does blow through P, it's going to exactly 1007.5. So we're definite buyers down here, but then so is everybody else. Everybody else has not forgotten this enormous rally that we had on the 3rd. So this rally turned everybody bullish. This correction merely confirmed their expectations that of soybeans taking a rest, and now we've got something beautifully impulsive. You can see it. It doesn't have the single bar A that we would have liked, but in all other respects it looks pretty good. We had an entry trigger at 976 1/8, and we got a minimum target 978 7/8 OCO with the stop loss on the entire position just at 973 1/8. So I don't know whether you want to risk 3 points, 3 cents on a zillion bushels there, but we could essentially scale. We could cut this entry point down to size just by going on a chart of lesser degree. All right, so keep in mind 976 1/8 was our trigger, but if we drop down to the 3, we're looking for entry opportunities of a much subtler degree. We're actually working on a bearish impulse leg now, A, B, C. Well, no, actually, we exceeded the point C there. So soybeans is sort of in a duel, meaning short-term bulls and bears are at a standoff, and you see dueling impulse legs. Bullish impulse leg followed by bearish impulse leg, followed by, we still haven't made a bullish impulse leg on a pattern of this magnitude. I would say if you're going to do a trade in soybeans, if you're going to get long, the trade, the opportunity I would look for would be an impulse leg that gets past internal, external, maybe ties with that external et right there. So let's see. Or, no, I don't think there is an or here. You could do it one other way, the way that I mentioned earlier, namely that if we get a move up to here and it just breaks out above that external high, there are enough of those math bozos out there with no trading experience that that we have them to thank for any rally that occurs from that point forward. In other words, I'm kind of liking the rally that ties that external peak there without breaking above it. Once it breaks above it, it clues in all the math majors that something is happening. And so we're better off doing something before something is happening. So I don't know whether you say we're breaking the original rule or whether we're creating a new one. But again, I more and more like that trade where we get something, a rally leg that's impulsive, but for the fact that it didn't really get past the required external peak there. But one thing we know about doing that trade is if we get a tie and it pulls back to a good discrete single bar C, we don't have time to think about it too much. The trade we're going to want to do the most is the one that pulls back and instantly it starts creeping up toward X that triggers us in. You need to take that X merely for the fact that not a lot of other traders had a chance to even ponder it for long enough to get in. So, all right, so that's how I would actually trade beans now. And again, on the larger chart that we looked at initially, we did have soybeans working on this bullish impulse leg right there with a minimum upside to, let's just work the numbers. We're going to stall at P, by the way. So I guess that somewhat tempers my enthusiasm for A, B, C. Well, no, actually it won't. I think we could still do the trade. But P for the moment represents an impediment. It's an obstacle to whatever rally unfolds. All right, I think that's it. We've had I've got an hour and 3 minutes worth of recordings. Let me just make mention of the fact that we looked at soybeans, and that's it. I hope you enjoyed the session. Obviously, we'll do these sessions from time to time, especially on relatively boring days like today. And with that, I'm going to wish you all a very, let me actually shut the recording down first. Just